Welcome to TheoTrade. This is Don Kaufman. July 22nd, 2022. Just minutes after the cash close here on this Friday afternoon. Here is why an onslaught of volatility is coming. That is going to be the topic of conversation here on this weekend's update. Let's get right down to it. Rather than spend a lot of time in a weekend review, yes, we had a rip and rally. Yes, we're going to talk about the rip and rally in just a moment, but that rally, kind of died out a little bit on this Friday. SPUs closing down some 38 handles to the tune of about 1%. Some rough earnings, but also a just ugly PMI, not only here in the US, but over in Europe. There was some ugly PMI numbers that came out. But before we go any further, they're back. The FOMC is coming back this next week. One of the first things to state, you don't have to spend all day worrying about this. Listen, just look at the Fed Watch tool, right? On this Fed Watch tool, whether you're familiar with this or not, it's all right, but on the Fed Watch tool, listen, the current target rate, right? This is where Fed Fund futures presently are. It's 150, 175. Then you look over here at the probability, which is just shy of about 80%. And down below, it says 225, 250. That basically amounts to the fact that there's a 78% chance that we will have a 75 basis point hike. Now, what is this number actually based on? That 80% or the 78%, what's it based on? It's based on a marketplace, the Fed Fund futures. All right, but I would be remiss not to mention the fact that there's still a 21% chance of a 100 basis point hike. So that's really only the topic of conversation, when it comes to the Fed. I think the only question is the Fed going to make any other, statements, ulterior motives possibly for quantitative tightening? Obviously, this week we're also kind of shocked by the ECB. That's the European Central Bank. European Central Bank, instead of actually doing 25 basis points, they went for a 50 basis point hike. What did it do to the marketplace? Absolutely nothing. Let's actually look at a little bit of price action. This is S&P futures over the last 30 days. I'm going to go ahead and close up this left side bar. What are we doing? So this area, when I see this area right in here, this is what I kind of termed a volatility box. And we are just a hop, skip, and a jump to the upside of the volatility box. One of the most pivotal levels, though, on this screen, and I was mentioning this every single day this week, this 39.31, that is what we term a gravity point. The marketplace has literally been pulled back there time and again, not just in the last 30 days, but in trade even well prior to this. But the 39.31 holds huge weight. I do believe we're going to see it make an appearance, of course, early next week in trade. And I think that's fairly pivotal, right, at that point in time, because then we could get knocked back into this volatility box. Anyway, listen, any way you want to slice this, I think you have to recognize the number of factors that are on the dance floor for this next week of trade is too numerous to even count. You want to talk about the FOMC? Fine. You want to look at tech earnings? Oh, fine. You want to talk a little bit about some of the economic data coming out? Oh, absolutely. There's some geopolitical talk coming out this next week. It's an absolute cluster of volatility. I mean, this is just, it's a week coming up where that the marketplace is just a pool of gasoline. And throughout the course of this next week of trade, all right, it's just, the market's going to be throwing matches at gasoline the entire week. In fact, you're going to see in a moment the implied volatility in the SPX is actually up. Given the fact that we had a rally this week, it's unusual to see that. And again, I'll explain that a little bit more. So, the FOMC is back. And I'm not going to make too many statements about it because it just comes down to the fact that, all right, 75 basis point becomes normal. How is that normal? How is the market accepting of this? Did we not see what interest rates did? Okay, just in this last day of trade here, when I'm talking about interest rates, I think the best way to actually look at the rates is typically to go over here to the small exchange, look at the 2 versus the 2 versus the 10. And again, I'm going to highlight these for you because not everybody is necessarily familiar, with what that terminology is, the 2 versus the 10. But the 2 and the 10, the 2-year, which is right here, is roughly sitting at about 2.91. The 10-year, which I just drew on, the 10-year is right here at about again 2.75. So the 2-year is 2.9K7, and the 10-year is, well, considerably like below that. I mean, we're just in an inverted yield curve. So I've got some strong feelings about what the rates are going to look like moving forward, which I'll discuss here. But it's again, everything is just compounding risk right now. And when I'm saying that, I want to be very clear about a statement. This weekend's update is entitled, here's why an onslaught of volatility is coming. Just because I'm talking about an onslaught of volatility doesn't necessarily pertain to just being outright bearish. I will make an opinion, and it is going to be bearish in the S&Ps, but I'm going to give you a couple of opinions about dollar and bonds, right? Some of the metals. We're going to talk about that here in a moment. But it's critically important to understand that there is a tremendous number of these binary announcements coming out. And the danger out there this week, it's huge. And again, I think that the first stop is going to be this 39.31, but thereafter, it's going to be Mr. Toad's wild ride. So let me give you a little bit of a sector by sector recap, starting with the S&Ps. So first and foremost, we come to the SPX, the mother of all products. So everybody this week is talking about this rip your face off rally, except of course this Friday kind of put a little bit of cold water on that rally. So we started rallying, okay, kind of mid last week or late last week. We started rallying. We rallied all the way from the low 3,700s, and we ripped and literally hit 4,000, contracted a little bit, and here we are at 39.61. The interesting aspect of today's close, we're a hop, skip, and a jump off the edge of the expected move. I'll be honest in saying I would count this one. Like you can see I highlighted it. And by the way, when I make this little highlighted area right here, okay, that indicates a breach of expected move. But quite frankly, it's a $3,900 product. It missed a line I drew on the chart by the end of the week by what? A whopping 10 handles. I mean, for me, count it, people. I think that that's fair to say. It's pretty efficient, not inefficient, but pretty efficient. But I do highlight it because any breach, whether it be a point, 2 points, or 100 points, I will highlight towards the end of a week. Nevertheless, this is nothing like any of these 2 or even 3 sigma moves that we have seen in some of the recent events this year. How are some of the other sectors looking? All right, financials. What did financials do? Let's actually apply auto expected moves. Pretty much spot on the upper edge of the expected move. Start looking down towards tech. What did tech do? Pulled in to the inside edge of expected move. All right, why am I going through this a little bit? Let's go to the energy sector. The energy sector hit the edge of the expected move. Mainly because I want you to understand nothing unusual happened in this particular rally. To me, it's just, again, this was that quintessential bear market rally. The correlation was incredibly high. Earlier this week on Tuesday, when we had the blistering move of 100 S&P points higher, we were completely and utterly correlated. The S&P 500 had 495 stocks trading to the upside. So again, it just reeked of a bear market rally. And here's a little bit of a pullback. Does that mean we're going to continue to pull back? No. And the reason I'm saying that, if you hear any uncertainty in my voice, it's ridiculous to just, have hardcore ideas in the very near term based on what? What do you got? A hunch? You have binary decisions coming out. When I say binary decisions, you don't know how the marketplace is going to react to the Fed on Wednesday. You don't know how the marketplace is going to react to a calendar just chock full of tech earnings. And it's an impossibility. But I am actually going to give you a little feel for that. And one of the reasons that I remain, again, this is an opinion, but I remain adamantly bearish. But that doesn't mean adamantly bearish on Monday, Tuesday, and Wednesday of trade. I'm bearish, okay? But my bearish sentiment, all right, it's for weeks, it's for months out. It's not necessarily tomorrow, which is Saturday and the market's not open, but it's not necessarily just, on Monday, Tuesday kind of bearish. Bearish further out in time. And now I'm actually going to get to reasons why. Respect the move and snap. A lot of people discount a move like this. I don't. I have the utmost respect for the move and snap. Does the move and snap, okay, mean that Facebook is going to miss horrendously with its earnings? And the answer is no. Okay. Does it mean that Google advertising dollars are going to be, abysmal? Because if you've ever looked at Google in terms of the business, hold on, let's actually just bring up Goog. Bring up their company profile. There's some disconcerting areas in their business, namely the 72.4% is advertising. Anyway, the reason I'm bringing this to your attention, it doesn't mean that, but you better respect it because it will only take one Google, okay, to take the entire S&P 500 apart. I just don't think that Facebook could bomb big time. Its market cap, it still matters. When I talk about the market cap, listen, Facebook's only a $458 billion company. I know it sounds small, doesn't it? You start looking at Google's 1.4 trillion. The point I'm trying to make is Facebook isn't going to absolutely decimate the markets. Google will. Google misses or Google comes in or Google warns, and it's going to be an absolute cluster out there. So that's why I'm saying you have to have the utmost respect for the move in Snap, especially when it comes down to advertising dollars. It definitely puts me on edge for tech earnings. But if anything, it's just going to create more volatility. It's one of the reasons there's an onslaught of volatility coming. Now, with that being stated about tech earnings, that are coming. I fear what has gone on in AT&T and Verizon. These, and again, my opinion in here, it is what it is. When you start hearing a CEO of AT&T, and I know we're looking at Verizon right now, but when you start to hear the CEO of AT&T mention that they're going to eat $2 billion by year end because people are not paying their cell phone bill, we got problems. Okay, we're talking deep consumer economic issues ahead of us. It's one of the reasons, that's not just lending support to being bearish in this marketplace. I think it's a pretty good reason unto itself. AT&T just got slaughtered though. This doesn't look like, okay, it only moved from 20 to 18, but AT&T, this is a product that doesn't move. This is a stock with a nail in its foot. This is a 15-year chart. And when you start seeing moves in a 15-year chart that are showing up, okay, as big as, like the onset of COVID, yeah, that's the kind of thing I'm telling you. Feel the fear. Look at the Verizon chart over the last 15 years. Serious, look at it with me. Go look at it yourself. The only time you see this kind of movement, right, wasn't even entering into COVID. This is one of the largest moves that we've seen, okay, since, for instance, financial crisis times. And that's how far back you have to go. And again, that's why I'm saying respect what you saw in Snap, fear the moves in AT&T and Verizon. If that kind of consumer behavior is relevant, we're in trouble. We're in real trouble because the Fed's still going to raise. It's not going to make a difference. They have to curb inflation. We're exporting inflation right now. It's ugly. Obviously, again, a big week for tech earnings. The calendar is chock full of events. The biggest event clearly is going to be the FOMC. Yes, there's durable goods. Yes, there's monthly GDP. Yes, there's jobless claims. I mean, pick any day. Pick any day. Oh, did you want consumer confidence in there as well as Case Shiller? Okay, it's an absolute crap fest of tape bombs earnings galore. Like this is going to be a big week coming up. And again, that volatility is coming with it. No question about it. Not a lot to get thrilled about in a week like this. Now, here's the opinion piece. Okay, so we know this onslaught of volatility is forthcoming. We're just going to come back into some raging volatility. No one cares that it's late summer trade. It's neither here nor there, right? What I would be looking for at this point, I'm actually looking for weaker dollar. And I want to be very clear about this. Okay, I'm looking for a reversal in the dollar. I think the dollar trade is over and done with. This was a big time, okay, fear me trade. So a stronger dollar, though, it's causing all kinds of issues, commodities all over the world. That's why I said we're kind of exporting, inflation. I think we're actually going to see, okay, some of the dollar fear trade dissipate. And rather per se than buying dollar, look, now all of a sudden we're buying bonds. So when you think of buying bonds, all right, bonds are rallying. So we're actually going to sell dollar, buy some bonds. If you buy bonds, interest rates, they're going to go down. And you're like, wait a second, this doesn't make sense. The Fed's raising rates. You're right. Okay, they're raising Fed fund futures. But if you look at like TYX, it's already going down. So yes, we're pricing in higher rates, but the rates that we're pricing in that are higher are actually in the shorter duration of the curve. So the TYX is actually backed off people. It almost hit 3.5%. It's all the way back to 3%. This is a huge move. I mean, in the last month, it's an absolutely huge move. Take a look at TNX. Everybody's complaining about interest rates. TNX just shy of 3.5%, now back to 2.78. Again, another critically large move. Meanwhile, as I showed you a moment ago on Tasty, just take a look at the 2 years all the way up to 2.9%. It's just a monstrous and massive inversion of the yield curve. A recession's coming. All right, it's one of the reasons, again, I'm going to look for a weak dollar, bonds to be incredibly strong. That is bonds, okay, and notes to be incredibly strong. And no question, that's where I'm going to say equities are going to be weak, right? And I have these trades on. I've actually got 2 of the 3 trades on. I'm actually short dollar. I'm definitely short equities, okay? I am not presently long the bond market. I'll tell you why I'm not long the bond market. I should have gotten in here, but I think it's a little late at this point to be long the bonds. But I think we could see some more rotations into bonds. Meanwhile, the weaker dollar has actually been really, really good for metals. Now, regardless if you think there's going to be weaker dollar or not, metals are about to have their time. Okay, metals have not participated at all in this, huge inflationary, environment. Everybody, you heard for the last 15 years, buy gold in a time of inflation, except you did and it didn't work. Well, here's your chance. Here's your chance. I believe that the metals are going to start to fly now. Okay, I think we've probably bottomed somewhere near the 1700 and we're going to rip. And again, it's largely predicated outside of the idea of looking at a gold chart. Like if you're looking at the gold chart, you're like, oh, he's looking, it had a 618 down there. Believe me, I'm not looking at any Fibonacci's like that. I'm looking at the price action inside of bonds. I'm looking at the price action inside of the dollar and being very decisive about those metals. One of the other factors I wanted to bring up is VIX. Okay, if there's a time to buy volatility, I think you have to buy now, forever hold your peace. The surprising aspect about VIX, that VIX today, even with the S&P selling off by 1%, you do realize that VIX came in almost flat today. I find that interesting. There's just not a lot of activity right now on the put side. And furthermore, if you look at the VVIX, that's the volatility of the volatility index, it is absolutely astoundingly rock bottom. The VVIX, you can go back now 5 years to see pricing in the VVIX this low. And again, the VVIX, it's the volatility of the options in VIX. And again, it's inherently low. So if you wanted a VIX trade, okay, act now or forever hold your peace. The VIX trade, I don't know, something like maybe buying the 30, maybe 35 spread. It's a 30-35 call spread trade of about 80 cents, shot in the dark. I mean, if the VIX in the next 60 days spikes, okay, you're home. Seriously, if the VIX spikes right back up here to where it was, I think it's actually a decent trade. And again, when else are you going to be able to buy volatility in the VIX this low? You may not be able to do it again for a considerable period of time. So volatility trade, because I don't think that VVIX, it's a low VVIX. I don't think it's going to last, right? So again, I'm giving you a lot of different trade ideas. The one thing, just because somebody says dollar weak, you got to figure out how to trade it. If bonds are strong, how are you going to trade it? Okay, I'm actually going to walk through execution of strategies around some of these ideas. It's fine when somebody, oh, dollar is going to be weak. All right, so how do you get short dollar? Oh, bonds are going to be strong. How are we actually going to get long bonds? No, equities are going to be weak. How are we going to get equities, without taking extraordinary risk in all of these binary moves? And that is exactly the premise of this next week of trade. Last, but definitely not least, SPX, the mother of all products. Last week, we saw about an $87 expected move. This coming week, $97 expected move. What's so entertaining about this? It's been a long time since we've seen this. Big rally this week. Yes, we sold off today, but big rally this week. And we rallied, but the expected move, okay, increased. So this week, again, we're looking for plus or minus approximately $97 and change, right? That basically means we're looking for a $100 move up, $100 move down. I'm going to go ahead and throw in there once again. Yes, we cracked expected move. We pulled back in. Oh, people, I'm telling you, a $100 expected move. You had multiple trading sessions this past week. On Monday, Tuesday, we moved like $100. It's impossibly difficult for me to get excited about a $100 expected move. I am telling you, this next week, you're going to be in an onslaught of volatility. Be prepared for it. The week might start off kind of mellow at this, pulling back to 39.31, but thereafter, okay, it's going to be wild. Be careful coming in, though, to the front of the week. And I say that simply because, hey, yeah, maybe we see that 39.31 and the pullback to 39.31, but lo and behold, positioning before FOMC, positioning before all the economic data, positioning before Google and Apple and Amazon and I mean everything, and Microsoft, they're all coming out. Okay, well, yeah, Microsoft too. Let's just throw it's a full-blown party of earnings this week. Positioning prior to some of these big earnings and prior to the FOMC, okay, that unto itself is going to create a tremendous amount of volatility this next week. So sit back, try to relax. You better know what your positions are. You better love some of the positions you have on, okay? Know your risk coming into this next week of trade. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.